got the deposit, you've seen the house, now you need a mortgage. But then someone mentions fixed rates, trackers and penalties, and suddenly you feel like you need a degree just to buy a home. Seeing as it's the most important financial decision you'll ever make, you should know exactly what you're getting yourself into. That's why I made this video. I've done it all before. By the end, you'll know what a mortgage is, how much it will cost you, and most importantly, how much you can borrow, as well as other essential information. Hi, I'm Matt. I worked in finance in London for 15 years and I hold a Chartered Financial Analyst qualification. Right, vamos. A mortgage is a loan.
No shit, Sherlock.
All right. You don't have enough money to buy a home outright, so you borrow the rest from a bank or a building society. It's known as a secured loan. The bank takes a legal charge on your property, which means until you've paid off every penny, they have a legal claim over your home. You live there, you maintain it, it feels like it's yours, but the bank is essentially a landlord until the debt is cleared. If you miss enough payments, they will repossess your home. So it's important you know what you're signing up for. There are two types of mortgages, repayment and interest only. With a repayment mortgage, your monthly payment covers two things: the interest on the loan and some of the loan itself. Every month, the outstanding balance you owe shrinks slightly. By the end of the term, you will own your home outright. With an interest-only mortgage, you only pay the interest. The original loan doesn't change, so at the end of the term, you will still owe the full amount initially borrowed. Not one penny is paid off. Think of it like a personal trainer versus a DIY fitness plan. Interest only requires real discipline, making sure you stick with a plan you made yourself. You need to be consistently setting money aside, either paying off the loan in intervals or investing the money elsewhere, which will gradually grow to pay off the balance at the end of the term. Repayment is the personal trainer. It tells you exactly what to do every month and keeps you honest. You only have to think about monthly payment. The balance of the loan is taken care of. Nearly all first-time buyers will be on repayment. Lenders generally won't offer interest only to someone without significant assets or equity. So I'm only going to talk about repayment for today. The mortgage term is the time it takes to pay back the loan. 7 in 10 first-time buyers now sign up for over 30 years. What I didn't realise is that since 2023, you can now push out a mortgage up to 40 years. It's gone up again. I can't say I'm shocked given the way things are going. It won't be long before the 50-year mortgage is out, and maybe even intergenerational loans. God forbid. It's not hard to figure out why. House prices have been rising faster than salaries for a long time. And to keep monthly payments manageable, people are spreading the debt over a longer period of time, which is ironic, seeing as the longer you spread out your mortgage payment, the more it becomes like an interest-only mortgage. A longer term means lower monthly payments, but you end up paying significantly more for your home in the long run. We'll come back to why in a bit.
Where does your monthly payment actually go?
You're in for a shock. When you first start paying your mortgage, most of your monthly payment just pays off the interest. Let's say you borrow 200 grand over 40 years at 5% interest rate. Your monthly payment would be about £960. In your very first month, roughly 830 of that is interest, and only about 130 is actually reducing the loan. You'd pay about £1,000 a month, and over 85% of it is just the interest. It's a joke, right? The structure of a loan repayment over time is called amortisation. Here's how it works. The interest you're charged each month is calculated on the outstanding balance at the time. This is how most loans work. So at the start, when the loan is at its highest, interest is at its highest too. And as you pay down the loan, the balance gradually declines. And because the interest rate applies to the outstanding balance, that falls too. But your payments don't change. Your payments are fixed. Well, how does that work then? Each fixed monthly payment services different parts of the loan, interest on the loan, and the loan itself, as we've discussed. And the composition of your fixed payment changes over time as you pay back the loan. By the time you're into your final years of your mortgage, most of your payment goes towards the balance, and the interest is tiny because the debt is nearly gone. Does that make sense? Because interest is charged on the outstanding balance, overpaying your mortgage reduces the balance faster, which means less interest charged for the rest of the term. The earlier you overpay, the more of an impact it makes. Now, I'm not going to go into that today. It deserves its own video. But if overpaying your mortgage is something you want to understand better, let me know in the comments below and I'll cover it properly. Loan to value, LTV. It tells you the percentage of the property's value you're borrowing. If the property is worth 200 grand and you're putting down 10,000 as a deposit, you're borrowing 190 grand. So the LTV is 190 divided by 200. Easy peasy. Your deposit is 5% and the LTV is 95%. The bigger your deposit, the lower the loan to value. The lower the loan to value, the lower your mortgage rate. Lenders use LTV as a measure of risk. If you borrow 95% and house prices drop 10%, you're in trouble. You now owe more than your home's worth, and that's a problem for both you and the lender if you get into financial difficulty. At 80% LTV, house prices need to fall 20% before the lender is in trouble, which opens up more offers and most likely better rates. You might have heard you can borrow up to 4 times your salary, and that's true-ish. Out of the salary you bring home each month, lenders are now very interested in what you spend your money on. You may think, using online calculators, that you've been lent money even if you can just about afford it. No. Lenders scrutinise your bank statements. They look at your outgoings. All of them. 2 people earning the same salary can be offered very different mortgage amounts based on how much they spend each month. The person with car finance and credit card debt will be offered far less than a hermit with minimal outgoings. It isn't just about whether you can afford the monthly repayments as it stands either. Lenders want to know if you can afford it when rates rise as well, at least 1% more than when you take out the mortgage. So if you're applying for a fixed rate at 5%, the lender is quietly asking themselves, could this person afford payments if the rate jumps to 6 or 7% later on down the line? Your credit score affects this process in 2 ways. First, it determines whether a lender will accept you at all, and second, it'll affect the rate you're offered. A strong credit history signals reliability, and a patchy one, missed loan payments, too much credit card debt, can lead to rejection at worst and at best higher rates. It's free to check your credit report before you apply. You can try 3 agencies: Experian, Equifax and TransUnion. Links below in the description. Before you start seriously house hunting, you'll want a mortgage in principle. It's a statement from a lender saying, based on what you've told us, we provisionally lend you X. It's not a mortgage offer, so it's not official, but it tells the estate agents that you're a serious buyer. Almost all lenders use a soft credit check, and that means it won't leave a mark on your credit file and won't affect your score. The proper check comes later when you make a full application. The most popular is a fixed rate mortgage. 85% of outstanding mortgages in the UK are fixed rate. Upon commitment, the interest rate is locked for a set period, typically 2, 3 or 5 years. It doesn't matter what the Bank of England does, what happens in the financial markets, what your mate tells you, your payment stays the same for a fixed period. This appeals to those seeking certainty. You know your outgoings, you can budget, and there's no nasty surprises. The trade-off is that if interest rates fall significantly during your fixed, you will not benefit. You're locked in. Another disadvantage that I argue is more relevant is that fixed rate mortgages come with early repayment charges. If you want to exit the deal before it ends, no matter the reason, you can be charged up to 5% of the outstanding balance, even if you just want to move home. And that's a lot of money. It is possible to move your mortgage to a new home, referred to as porting your mortgage. But this depends on what you initially signed, so check with the lender before you commit. After the fixed period has ended, you'll automatically move on to the standard variable rate. We'll talk about that in a minute, but there is absolutely no reason you should ever be on this rate if you can help it. A tracker tracks a Bank of England base rate plus a spread. If the base rate is 4% and the spread is 1%, you're paying 5%. If the Bank of England drops the rate to 3.5%, you start paying 4.5% automatically. Trackers can end up cheaper than fixed rates when base rates are high and expected to fall, but if rates rise, so does your monthly payment. For me, it worked perfectly. My fixed rate was coming to an end last summer, and I knew I was going to market my flat, so there was no point me taking another fixed deal because of the penalties. Trackers allow you to pay back the mortgage amount in full without penalty. Even for the simple reason that you think rates will start to rise, no problem, you can switch. However, for someone on a tight budget, that unpredictability can be stressful. For someone wanting flexibility who believes rates will fall, the position I was in, can work out better financially. Okay, the standard variable rate. If you do nothing when your deal ends, this is the rate automatically applied by your lender. It is the most expensive option. Do not go onto this rate. SVRs aren't tied to the base rate, but they're set by your lender. They are not competitive. For example, HSBC's standard variable rate on a 95% loan-to-value mortgage is an extra 1%. Big deal. So what? Well, using our early example of borrowing 200,000, that translates to an extra £135 per month. If you're a basic rate taxpayer, you'll need a £2,000 pay rise just to cover it. They exist because they know people bury their heads in the sand assuming it will miraculously sort itself out, or are too busy. Laziness definitely has a cost. Why pay hundreds more per month than you need to? The only good thing about moving on to a standard variable rate is there are no penalties for full repayment. This is handy if you're moving home just after your fixed deal ends. You can probably suffer a month or two on SVR rather than going through all the paperwork for a tracker. But generally speaking, don't go onto an SVR. Okay, fine, you know how a fixed rate mortgage works. Now you're deciding on a 2, 3 or 5 year period. A 2-year fix gives you more flexibility. You're locked in for a shorter period, which means you'll be back on the market sooner, either to remortgage at hopefully a lower rate or to move without worrying about exit fees. A 5-year fix gives you certainty, no rate risk, no remortgage faff halfway through. But everyone's different. Personally, I don't like being tied down long, but you must consider what's right for you and your circumstances. If you don't plan on moving for a few years and you can afford the repayments, then honestly, go for peace of mind. Global economic events keep throwing up surprises.
Iran's stranglehold on the Strait of Hormuz is still holding oil markets hostage.
If there's room in your finances and you might move, 2 years probably makes more sense. And if you want something in between because you're not too sure, the 3-year might help as well. Now, some lenders charge an upfront booking fee in exchange for a slightly lower mortgage rate. I don't want to dodge this question, but there are many variables that dictate if this is a good thing to do or not. What the difference between the rates is and how much you're borrowing are the main factors. Here's an example though. If you decide not to pay the upfront fee and take the higher interest rate, you'll pay an extra £20 per month using our earlier borrow amount of 200,000. If you take the 2-year fix, this works out better as you'll only pay an extra £20 a month over 24 months. If you take the 5-year fix, the higher rate works out more expensive, so you're best to pay the fee. However, if you don't have cash immediately, given how hard it is to save a deposit as it is, then you can add it to the balance of the loan. It means you'll pay interest over the life of the mortgage, but you can always overpay by that amount when you have more spare cash. That's just something to consider. When it comes to taking your first steps, you've got 2 options. Number 1, go directly to a bank or building society, you peruse their wares, and you take what you're offered. Your existing bank isn't a bad place to start, as you can use that rate as a benchmark against other lenders. 2, using a mortgage broker. A broker searches the market on your behalf, often hundreds of lenders, matching your circumstances to the right product and handles much of the application process. A broker gets access to the hidden criteria of individual lenders. They know which lenders are more flexible on certain income types, which are stricter on credit history, and which have the best rates for your deposit. That expertise can be the difference between a declined application and an accepted one, or between 2 different rates on the same mortgage. They also have access to broker-only deals, products that you won't find by Googling. Most mortgage brokers in the UK are fee-free. This is what most people don't know. They're actually paid by the lender and not by you. The lender pays a commission when a mortgage completes. So the broker's incentive is to find you a mortgage that completes, which aligns with your interests as well. Some brokers do charge a fee, particularly for complex cases, but for a standard first-time buyer, you can almost certainly gain whole-of-access market advice for absolutely nothing. Check before you book, obviously, but don't assume it will cost money because it usually doesn't. Honestly, most first-time buyers benefit from using a broker, but especially anyone who's self-employed or has variable income, anyone with less than perfect credit history, anyone buying with a small deposit, or anyone who finds the process confusing and wants someone to explain it as they go. You know what a mortgage is, how repayment works, and that when it comes to deposit, size really does matter. Knowing the difference between fixed and tracker already puts you ahead of most. And remembering that standard variable rate is a shocker, you'll be in good stead. If you haven't already, check your credit rating. It's really easy. I've left links below for you. I personally use Experian, but there are others. Again, I have no affiliation. Drop a comment below if there's something I didn't cover that you want to know more about. Whether it's overpaying your mortgage, shared ownership, stamp duty, whatever. Just let me know. I'll see you in the next one.